Hello, I'm Olga Collins, CEO of WBN. Welcome to this global perspective on the insurance market. As a network, it is our mission to provide creative, personalized, worldwide insurance and employee benefits solutions by working as one to meet the corporate and local needs of multinational businesses. But we know that the challenges and opportunities can look very different depending on where you are. That's why we've asked our board members, each a leader in their market, to give you their assessment of what's going on in the region. Their perspectives showcase the strength of WBN, local expertise combined with real global collaboration, and personal attention across the world. For detailed analysis of market conditions in your locations, get in touch and we'll create a bespoke market report for you. And now, over to our board members to take you around the world.
The North American market in 24 has been very fragmented, meaning that the US activity, capacity, and environment is very different than the Canadian. So if I look at the US marketplace in 24, no surprises in the property and casualty area, moderate increases basically across the board. Challenging lines continue to be auto. Workers' comp in the US is doing very well. There's a lot of capacity, there's a lot of growth in that area, and they're seeing some good rate in that area as well. So that is moving along well. Overall lines of business are doing well. The property lines of business, basically flat across the board. The industry core in the US as of Q3 was around 98%. I would say some of that is gross written premium growth, which is at about 9% year to date, which is higher than what the expectations were as we came out of the beginning of the year, Q1 and Q2. What the insurers and reinsurers are saying for 25 is that those increases will probably moderate down to maybe 5% or slightly a bit less. But overall, doing relatively well and stable with the reduction in inflation, as well as the increase in investment returns on portfolios, the overall market's doing well. If you transition that to the Canadian market, it's a very different story. While the insurers are doing relatively well year to date, it has been our largest CAT year in history. So just the summer months, 3 months, June, July, and August, we had $7 billion of CAT activity and claims in the insurance industry. Year to date, we're just under $8 billion in CAT costs for Canada. And about 50% of that is approximately being paid through the reinsurance marketplace. The balance would be paid through the primary markets. A lot of the reinsurance treaties renewing 1/1. That's going to be very telling to us as to what is going to happen in the market next year with respect to rates. We have typically only seen rate increases this year in the personal insurance lines. When we look at the financial lines, the D&O, the cyber, significant rate decreases. In the D&O lines, we've seen rate decreases of 30% or higher. In the cyber, 5 to 10%. So as we look at finishing out 24 and moving into 25, what should the clients expect from a commercial perspective? From our lens, we are saying that from a commercial auto perspective, continue to see, rate increases. Although it is a challenging market and insurers are not making money, if you get ahead of it, there's still capacity out there and we can still place the auto, but looking for government and support from regulators to make sure that we've got that price properly. So still moderate increases from a commercial auto perspective. From a financial lines perspective, if we're talking D&O, if we're talking cyber, we are not expecting to see the decreases to the extent that we did in 24 and in Canada, and in the US, we're expecting them to still be moderate. So they would typically be the normal inflationary increases as we go into 25 from a property and casualty perspective, unless you're in a cat-prone zone from a commercial perspective, a manufacturing facility, or you have profitability challenges with your account. If we look at challenges and risks, potential risks in 25 in North America, I think the themes are common across both countries. The regulatory and compliance landscape continues to change, which can create all kinds of issues within our industry. And so we're watching that, and we are responding and working very closely with the governments and the government bodies, both nationally, regionally, and from a state perspective, to make sure we're managing that. But there's a lot of flux in that as well. Cyber threat continues to increase, which is a big challenge for our industry as well. Challenges in the unknown with technology and AI. What does that look like from an industry perspective? What are we going to use? What are we going to implement? How is that going to impact our workforce, et cetera? And how are we going to invest in that? Also from a client experience perspective, which continues to be a challenge for us. And climate change is right up there. I mean, when I talked about Canada and the cats that we're seeing, significant cats in the US as well. Their market is much larger, so it can absorb more, but we know that the frequency is only going to continue and that the severity is as well.
I think if we talk about employee benefits first, and we talk about Asia Pacific and the Middle East, two clear things happening in 2024, which will roll into 2025 and beyond, I think. The first is basically medical inflation, claims utilization. We're seeing very strong inflationary figures in healthcare treatment costs, which is then translating into healthcare costs. So most clients are struggling with very large increases and how to deal with that. And that's the first trend we're observing. And the second trend, which is in many ways a response to that, which is the increasing interest in flexible benefits. So we're getting much higher interest levels amongst clients in Southeast Asia, in Malaysia, in Singapore, in Hong Kong, China, interestingly also in Australia, and very significantly in the Middle East. So that's going to be one of the key pieces of technology that's going to increase employee engagement, appreciation of their benefits, but also as a cost control mechanism against inflation. In terms of P&C, nothing dramatic changing. Obviously, rates are always an issue. I think clients are getting more joined up, more sophisticated, looking for more consolidation, data transparency, but no major changes over the last 12 months. Clients are looking for more joined up solutions, looking for more consistency across different locations. And I think that's where WBN plays very strongly, actually. We are very joined up, and we're very good at giving that transparency to clients. Surprisingly, I found out about a client yesterday, and when you looked at their structure and how they operate, they're very fragmented. This is a global multinational, and there's so much value add we can bring to a client like that, EB and P&C. So there's a lot of clients that still can make that big step forward in terms of running global or regional solutions.
In India, we continue to see a significant amount of medical inflation, anywhere from 12 to 14% a year. And this means that, companies typically need to recalibrate their sum insureds and their limits, simply because every 4 to 5 years, you have a doubling of, costs for employees. And this either means that companies get to reduce their benefits to meet their budgets, or they kind of, increase their budgets. And we're finding some companies removing parents from coverage or making things voluntary for employees. So this continues to be a bit of a challenge. We are also seeing an extremely soft property cycle in the Indian insurance industry. And the third thing we're seeing in India is mushrooming of insurtechs. And while they're trying to do things differently, we think it's good for the industry because they simply, help us open up the ecosystem, the technology ecosystem with underwriters. So wherein insurance companies are willing to integrate on APIs with them, and therefore with us and everyone else. So I think consolidation in our market, both on the manufacturer side, the insurer side, and the distribution side, which is the broker side, continues. So that may create some amount of opportunity and the ability for clients to shift or not be comfortable with a new team or be comfortable. So, this is something that we'll just have to wait and watch. But I believe that, this is only going to accelerate in our market. We are finding, personalization and flexible benefits to be really something that's helping clients differentiate their employer value proposition to their employees. We're finding the really large companies now looking at flexible benefits. One is to provide a differentiated value proposition to their employees, and second is to reduce and maintain costs. So we believe that this is only going to accelerate. And when you have integrated systems and technology and consulting and the entire outpatient care network in place and other providers now coming in to the flexible benefits landscape, it really provides an entire platform for employees to make choices and personalize their benefits to suit their needs. Risk, as far as weather risk goes, that is something that's a cause of concern for everyone across the world, and it's no different in India. We are seeing some amount of companies and states both buy parametric coverage, and though it's just the start. But our belief is that, it is the way forward because, the documentation, the time to recovery of claim and to indemnity is so significantly lower, and it's trigger-based. So it's a no-brainer if you ask me. AI is another big thing that, possibly can lead to some amount of cyber, exposure. And cyber is, again, a significantly important topic for many of our clients. And, it is getting harder to buy cyber coverage, and many insurers, are kind of reducing capacity. So we find this sometimes to be a challenge, but challenges are good because they force you to think out of the box. They force you to explore the opportunities and help solution for your clients.
What we've seen in 2024 is that we're coming out of a hard market, especially in the property markets, and we see that there's coming more capacity into the market. Some lines actually a lot more capacity, like cyber and property. So we see market softening a little bit, and I think that's a good thing because after many years of hardening markets and rate increases, I think our clients love to see a little bit slowing down of that. The companies that have their prevention and incident response in good order, they have seen decreasing rates on cyber and more capacity actually in the market. So I think the main development in 2024, and it already started a little bit in 2023 and before that, but I think the whole geopolitical developments in Europe and in the rest of the world are in a way worrying, and it will impact at some. It already has, but it's going to impact also in the future the business environment, and it will impact the insurance market as well. So, in the short term, I know more on a micro level, we see that we are able to provide to many of our clients sort of stable rates and even some decreasing rates. So that's, in our business. But at the same time, I'm concerned is a big word, but I'm kind of wondering what 2025 politically will bring to the world, right? And with everything that's going on. And I think we need to prepare ourselves for that, and we need to also prepare our clients for that and help them with that. Now, if you look, for instance, in the stock market, it seems still quite positive and optimistic. And then whereas in some parts of the real world, there seems to be a sort of a gap between what the future might bring us and what we think the future is going to bring us. I see a couple of things that will impact 2025. With geopolitical tension, we still have a relatively high inflation rate. We have a lot of regulatory things coming our way in Europe: DORA, privacy, ESG. We have an aging population, so we still have a huge quest for talent. So there's all these elements that are challenging for the year of 2025, and then still there's also signs that make you very optimistic.
Well, yes, the Latin market is pretty dynamic. It is small compared to the worldwide market. I think we're around 4 or 5% of the total premiums that are exchanged worldwide. This is including Brazil and Mexico. as a percentage of the total expense of a country's GDP, we would find the developed country to be spending maybe 7% of their GDP in insurance. And in the region, except Chile maybe, the rest of the countries are close to 2.5 or 3% of their GDP being spent in insurance. So there's a lot of space to grow. But on the other hand, there's not a lot of interest of final customers to buy insurance. So there's a distribution challenge, and there's also a cultural challenge there. The market has been evolving positively, especially in favor of the customers. If I had like a chain, I'd start from the reinsurance market, moving towards the region. We have now the markets based more not in London but in Bermuda, Miami, and in the local Latin American region. We have found that many reinsurers have decided to open direct insurance companies in the countries, and then they have less loading on the prices that the end customer receives. In the space for brokers, there has been a large consolidation, which means there are less brokers and larger brokers. This has also led to certain clients that are personal lines or smaller clients are not being serviced as much as by brokers, but more by the insurtech operations in the region. Yes, in 2025, I feel the market has been evolving all the time, technically looking for alternative solutions. And one of those solutions has been the parametric coverages. We had challenges with parametric coverages. Many of them were legal. It was hard for all of the local authorities to understand that you could have a claim where there hadn't been a loss from the client, but he got paid anyway, or a loss from a client which did not reach the parameter and therefore was not paid and could not be claimed from the insurance carrier. But I think it's an easier way of placing risks. It is a faster way of settling claims, and it's definitely a way of accessing the market in a market where the climate change and the changes in our environment have led to potentially very large claims. The cyber risk is something that is constantly growing. We had a cycle where at the beginning carriers were very generous in giving coverages. Then there was a large amount of claims. The coverages became expensive, especially the ransomware, and it has reached an equilibrium. But definitely, we will be seeing a lot more cyber risks and cyber claims, cyber exposure from everybody in the market, personal lines, companies, and now all these softwares that drive your car and that handle your equipment in factories, etc.